From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, May 22nd, 2026. Let's have a look at the calendar. First off, I got a quick correction for you. The Brewers and the Dodgers are actually battling it out this weekend over at AmFam Field. I did make a bit of a boo-boo last week, so if you showed up to an empty stadium last weekend, let's just call it early tailgating practice. And if baseball isn't your speed, the Bradley Symphony Center is celebrating the country's upcoming 250th birthday with America the Beautiful Patriotic Pops. It's a musical journey showcasing the evolution of American music. And if you're feeling hungry, you can join the Tacos and Tequila Tour this Saturday. The organizers claim the samples are substantial. I don't know about you, but when it comes to tequila, substantial usually means I'm gonna need a substantial nap afterwards. Down in Florida, a motorist was caught driving well over 100 miles an hour, leading to a high-speed police chase and a thoroughly wrecked car. Now, high-speed chases aren't exactly unique these days, but this guy's logic certainly was. Upon his arrest, he had just one burning question for the officers. Should I get a faster car next time? You got to admire the commitment to the flawed logic, because some people just never learn. Speaking of things we wish we could fast-track, now I'm a few days late on this, but Wednesday was National Be a Millionaire Day. So, if you missed out on celebrating that this year, I might know a guy. Finally, my favorite headline of the week comes out of the Northeast. Students at Maine High School accidentally fed dirt during dinner. And I feel like that's a headline that's just begging for a story that starts with, back in my day. On the podcast today, we've got Dave Sandstrom, John Sandstrom, and taking a look at the week, here's Kyle Tetting.
Well, thank you, Jason. A pretty positive week overall. Nasdaq up 0.5%, up 119 points on the week. The S&P up 0.9%, closing at 74.73 on Friday. And the Dow Jones Industrial Average up 2.1% this week. Ahead of a shorter week next week with the Memorial Day holiday on Monday. For the year, Nasdaq up 13.5% now, the S&P up 9.5%, and the Dow up 5.6%. Dave, hard not to start the conversation here with a look at kind of the end of earnings season. It was an exceptional first quarter. The S&P, still 29 businesses left to report, but really the bulk of everything we were looking for with businesses like NVIDIA, some of the retailers coming out this week, has pretty much been made public at this point, and up 29% in a quarter, I think portends exactly what investors were looking at when they started to kind of look past some of the immediate impact of the Iran war, when we transitioned into the start of the second quarter here, and it felt like it was virtually straight up for stocks. I think the problem, of course, is that now that we get to the end of meaningful fundamental data, what's left for investors is perhaps more headline risk now, perhaps some more volatility if we don't get some clarity on what else might be out there.
Kyle, I think you hit the nail on the head. It may be time to fasten your seatbelt here for a little bit as it relates to volatility. It was encouraging in my mind to see investors paying attention to fundamentals during something like a conflict that we're seeing in the Middle East. Sometimes we allow those headlines to really sway our decision-making, but it appeared to me that investors were solidly locked into what was going on in the earnings environment, which was obviously outstanding. So we'll see. I think, like you said, it could be a volatile time coming here as investors look for something to grab on to in the headlines.
No, I think that's fair, and forecast earnings growth pretty strong still as we look ahead to the year. The problem, of course, is that we started the year with stocks being fairly expensive. They got a little bit cheaper through February and March before really coming back pretty strong now. A forward PE on the S&P 500 of about 21.5. Not quite fair to say that they're even close to inexpensive at this point, and I think it does speak a little bit to maybe some of our expectations going forward. One of the things you and I, Dave, have been looking at is what's happened in the interest rate market. And it's really interesting to compare what you can get in terms of earnings yield, buying stocks, right? What should you expect in terms of earnings for every dollar you invest in the S&P? Well, right now that's about 4.66% or 4.66 cents for every dollar you spend. On the other hand, we've got a 10-year Treasury pushing 4.5. It was 4.6 at one point in time at the end of the week last week, settled back into 4.56. And I think there are a lot of questions now about the Treasury market and a lot of questions more broadly about what's happening with interest rates.
And I think this is one of those headline stories that you're going to see continuing in the coming months, Kyle. I think there's been an enormous increase in interest rate related articles popping up, and unfortunately, some of them have been pretty gloomy. You get writers that are trying to get clicks and trying to grab your attention. So when we saw rates, dip earlier in the year, just a little bit below 4% for a little bit, and then we went all the way back up to 4.8, then that's when the gloom and doomers came out about, the sky's the limit. But just a little historical perspective on interest rates. You look back over the last 50, 60 years, the average 10-year rate was just a little bit over 5%. Today we're sitting at that 4.5% range. So, historically we're right in that, I would call kind of that sweet spot of the Treasury. And I think more importantly, investors typically focus on what we call the real yield, which is the difference between that nominal rate, the coupon, and what inflation's standing at. And historically, that's sat at just under 2%, a 1.9% real yield. So that's what you get to keep after inflation. And right now we're sitting at about 1.8. So I think that yields are in a pretty historically consistent spot right now. Kind of cool that temperature a little bit on kind of panicking maybe about where yields are at right now. I think if they tick a little bit higher, I would have to even suggest that maybe that's a great time to lock in some rates.
No, I think that's fair. And some of the concern has certainly stemmed around this idea that the longer the Iran war drags on, the more oil prices continue at the $100+ a barrel range, it's going to be really hard for the Federal Reserve to cut rates the way maybe we had assumed was going to be the case earlier in the year. You've got Trump this week essentially saying that Warsh, as now Fed chair, is free to do whatever he thinks is appropriate. It's not quite that simple because the Federal Reserve isn't ruled by fiat. It is a board of governors that vote on what should happen. And so that board, having already met this month, and we got news on that this week, Wednesday, that board has essentially said they are more than willing to raise rates if they need to. And I think that at least a little bit gave investors some pause that maybe we do have a little bit higher rates. Of course, a reminder that the Federal Reserve controls the overnight lending rate. The market more broadly controls interest rates, looking out beyond just what does it cost to borrow till tomorrow. And so when we look at something like a 10-year Treasury, for example, again, a little more than 4.5% right now, well, that's much less driven by what does the Fed say and more driven by what does the market believe is going to happen. And I think if we see some of that volatility that might be coming for the stock market, volatility not always bad, but it does mean, hey, buckle up, you might get a little more interest now in some of those 10-year Treasuries at what I think is a pretty attractive rate. Again, 4.66% earnings yield on the S&P, 4.55 on the 10-year Treasury. Those are close enough that I'm not terribly inclined to say, maybe we should really be piling into stocks right now.
And it's, that's the key to it right there, right, Kyle, is look at the risk-adjusted return there. Putting up with the stock market risk and the volatility versus, locking into the 10-year.
And I think what we're talking about is not where should I go with my whole portfolio, it's where should I go with the next dollar, right? We always talk about on the margin, what's the next trade? Is the next trade lean into risk, lean away from risk? And I think right now I'd be quite happy to pull some money out of the market at these high prices. But long term, there are such great opportunities that it's not as simple as saying, well, let's just sell at the highs and wait for it to get cheaper again, because we've found that actually over time, high highs become even higher highs if you can wait it out a little bit. And so the goal right now, I think, is, okay, let's lean into some of that opportunity and higher yields and fixed income. They might get higher still. But if I'm buying something for the next 10 years, like you would be with a 10-year Treasury, I'm pretty excited about a 10-year Treasury at 4.5, even if inflation does average a little more than 2. You know, John, one of the interesting stories this week, and it's something we have been looking at quite a bit, is the prevalence of new issuance of exchange-traded funds. And I think often creating product just because we can, not because maybe there's a true market demand for it, but somebody I know we all read pretty closely week to week, Jason Zweig, came out with an article in the Wall Street Journal very recently pointing to exactly those issues. What kinds of things are we seeing out there, and why should investors be maybe a little bit more cautious in their approach?
Yeah, and what these articles have kind of showed me is that it's extremely important for the investors to understand what they're buying, both from an expense standpoint, from the actual investment ETF itself, and also from an underlying investment standpoint. It is extremely easy nowadays to create an ETF, and people are doing all sorts of crazy things. We like ETFs from the standpoint that they're relatively inexpensive. They track broad-based indexes. It's a great way to get cheap exposure to a variety of different parts of the market. Give you a little bit more tax flexibility as well. But that doesn't mean that we like all ETFs. There's ETFs now that are actively managed, which we like active management as well. So that's not necessarily a bad thing. But some of the active managed ETFs that are coming out nowadays are pretty ridiculous, extremely confusing, using derivatives, options, leverage, stuff that the average investor just will not understand, and then they get charged, almost a full % to own it.
Yeah, I think it is so interesting to look at the push that I think existed a few years ago towards the exchange-traded fund or ETF marketplace and go, well, yeah, more investors should be owning these types of products. Of course, you hit the nail on the head with the problem, which is yes, but not all of them and not in every scenario. And I think the reality, and I've kind of framed it this way for a while, is that it is no different than a mutual fund or any other number of packaged products in its underlying construction. It's the same piece of candy, it's just in a different wrapper. And so that wrapper can be lower cost, or it can be more tax efficient, or it can have some different bells and whistles. But if at the end of the day, you don't like the underlying candy, it really doesn't matter what wrapper you're purchasing it in. I think we need to be very careful, as always, that what we are recommending, what we think we should be buying actually aligns with our goals as investors. And again, I think it's far too easy now to create these products. It's gotten so cheap to create an ETF. I was doing a little research before the show just to back into, okay, how costly would it really be to build one of these? $50,000 to $75,000 just for filing fees with the SEC, which maybe sounds like a big number until you realize that, yeah, they're charging an exorbitant sum to invest in them. And then maybe a couple $100,000 a year in oversight. It really isn't that difficult anymore to create these products. And so I think if we are looking at, well, okay, what's best for investors, it's a great structure, but not all of it. I think the other thing to point out is that for many investors who already own them, well, probably a good reality check on, did I buy something that made sense, or was I chasing something just because I thought that wrapper was the place I wanted to be? Dave, a big week overall for the housing market. We look at the economic data. And one of the things I look at a lot is, what are we seeing in terms of household formation? What are we seeing in terms of kind of what the realtors and home builders see out there? And in particular, I was struck by a home builder confidence number that we have not really talked about before, but I think which points out that home builders are pretty pessimistic about kind of what's going on in the world. You add in, we got a report from the University of Michigan on consumer sentiment more broadly. I think it tells a story that by and large, people still don't feel great about what's going on.
Yeah, it's really been strange, Kyle, really for the last 18 months or so on those consumer sentiment surveys, because historically, you look at the big picture. I mean, University of Michigan's been doing this for many, many years. there's always been a high correlation between consumers' confidence and their spending. But we've seen a real disconnect in the last couple of years where people respond to the surveys that everything is terrible, and yet consumer spending continues to go. There's no clearer example than this weekend. We're looking at the highest gas prices we've seen in this country for many years, and we're expecting record travel this weekend. So amazing. Consumers will tell you how lousy they feel about it, but they're not putting their wallets away just yet. As it relates specifically to housing, I do see it. I have anecdotal evidence from clients that are in that business telling me that they are struggling with the employment picture. A lot of it has to do with the amount of spending going into data centers across the country. Big tech is not so concerned about how much they're going to pay that electrician per hour, but a small home builder can't compete with that. So they're experiencing a tough labor situation. The market still remains locked up with inventory due to mortgage rates being at 6.5. So I understand that the confidence in the household formation being as low as it is.
Yeah, and one of the things we've seen in that data on the home builder side is that the higher priced homes tend to be selling well. The higher priced new construction, those builders tend to be doing all right. But the only other area that's really strong right now is multifamily construction. And then when you look at the consumer side, it tends to be that those that can afford to travel, those that maybe have a little excess cash, they feel better because their stock portfolio is up now. But when you look at maybe those without a college education, when you look at lower earners, they tend to feel a lot worse right now because they have been much more impacted by those high oil prices, those high energy prices, and higher costs overall. And so I think there is still this kind of dislocation between those people who are spending, who can afford to continue to spend regardless of price, and those that maybe are becoming a little more price sensitive. And we have seen that in some of the retailer reports. We have seen some of that across consumer confidence in some other areas. I think the other thing that really jumped out to me this week, and John, this is something I know you and I have talked about a little bit and something that I share with clients quite a bit, is that manufacturing in our country has actually taken a little bit of a step forward. We had the PMI report, the Purchasing Managers Index report this week for manufacturing, but we also had a couple weeks ago Caterpillar report kind of this massive backlog. You worked for one of those companies that certainly spent a good amount of money building out infrastructure. But one of the things that I think is so interesting is just how much manufacturing has taken a big step forward.
Yeah, and a lot of it has been, CapEx spending by these gigantic, hyperscalers for AI, data centers, and everything that has to go into, building out all of that infrastructure and all the spending. It's funny that we talked about that. Those Caterpillar is one of those names, and some of those other, construction names where it's like there's only so many of these huge manufacturers that you can recognize that are going to be around to build all this out.
Yeah, and eventually that spending does tail off a little bit, but when you look at the backlogs for heavy equipment, when you look at the amount of demand for copper, for any number of those resources, I think there is a story that speaks well to a market that has some legs, even if it's an economy that I think is a bit more diverse than just, everything looks fine. And so the economic data, the unemployment numbers pointing to an economy that's strong enough. I think some of the concern that's out there is rightfully placed, but when you get to kind of the bigger long-term picture, I'm ecstatic at how well things have kind of moved beyond just the immediate concerns of the war that's out there, and obviously continues to kind of be the elephant in the room. And so, from an investment perspective, balance has clearly worked. I think from an investment perspective, a focus on the long run for stocks is going to benefit all of us. But obviously, we need to be careful. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.